Hello guys, today's video is a continuation of the new agenda. We can say we are trying new things on this channel and hopefully you'll like it. So, I previously mentioned in the previous video, we will be testing many scenarios on real markets with real money. And this time we'll be building a short-term portfolio of stocks for a month duration at least. And in the next few weeks, I'll be making videos with updates. So maybe let's discuss what type of criteria I choose to create this portfolio. So let's start from the first one, which is a price to book value. And this one helps you determine if the company is properly valued and how it is trading relative to the company's assets. So the lower the value, the better. Companies with a value lower than 1 are potentially very cheap in relation to their real value, which means potentially, this is a key word, a very good opportunity. But when building this kind of portfolio, and not long-term one, we will be using the opposite values. So for us in this project, it's better when the number is bigger. So next one is the return on equity, which is a measure of a company's financial performance calculated by dividing net income by shareholders' equity. This is a very important measure. This is basically why the tech stocks were such a good investment lately, despite being a bubble that many have thought. Thanks to low interest rates, companies with big ROE, which is return on investment, performed tremendously over the last decade, at least say, because all they needed was a capital, and with the low rates, they could afford it easily. I will talk more about that on another occasion because this is a very interesting and a broad topic. So, next gauge is a fourth quarter increase in revenues. This one is self-explanatory. Trade with the trend, right? And when there is a trend in profit, most probably the price of the stock will follow. Next is a consecutive 3-year revenue growth. Again, the higher the better, and all of the previously mentioned gauges taken into account need to have high values. Next one is the dividend rate. Here we are looking for the lower values. The lower, the better. And you most likely thinking, but is it not better to have the company which pays a high dividend? Well, to understand that basically, when the price of the stock goes up, the dividend rate should not increase or increase by a small amount. When the stock price falls, then the company can raise the dividend rate to compensate for the losses. That's a very basic explanation in a nutshell. Fun fact, you have probably heard many times about dividend aristocrats. And this term goes to a company that increased its dividend rate every year for over 25 years. Next one is the dividend payout ratio, which is the ratio of the total amount of dividends paid out to shareholders relative to the net income of the company. It is the percentage of earnings paid to shareholders via dividends. Again, the lower, the better. And the difference is that the dividend rate is an annual yield. For example, if a company paid a dividend throughout the year of $2 per share, that is the dividend rate, while the payout ratio is a percentage of money paid to shareholders compared to how much money the company really made. Okay, on the next three, I think I don't need to talk about too much, so I will just briefly talk about them. So the first one is a share of the short-term debt, self-explanatory. Next one is the debt to equity. And about these two, the lower the better, of course. And the third one is cash coverage. Here, the higher the better, of course. I think I don't need to dwell on it too much. But as for the debt, we need to also take into account factors that each sector has its peculiarities. For example, companies from mining or constructing sector will require more cash to operate and invest in new projects than, for example, some internet store or even a store with the physical locations. So, not to make this video too long, I will just display the companies chosen by this criteria and show you the traits. But that's not all. I will also choose 4 other random companies to have a comparison of which is better in investing for midterm, long hour preparation, analysis of multiple factors, or just a sheer luck. Ah, gotcha. I'm kidding, of course. We all know that this is a pure lottery, but I decided to choose some of the companies that maybe doesn't fit the criteria but has a good business model and current fundamentals are in favor for them. And it will be just interesting to see the results in comparison. So yeah, let's jump into the platform and talk about the trades and the companies themselves. Okay, so now we are in the client's cabinet in Litefinance account. So let's check the trades. And you need to have in mind that I already took the trades on a Friday. So therefore, you already have some current change in the profit of the trades. And you need to have in mind that this is a monthly project, so we will discuss the overall the statement at the end of the month, and resume all of the pros and cons of taking the trades based on strict rules, strict we can say some algorithm of decision making, and compare it to, for example, the more or less more of a cursory analysis, the overall brand assessment, and the current market situation, because that was the point where I was deciding whether to open a trade on those additional 4 stocks, because some of the stocks maybe not fit the criteria that much, but it has a good business model and the fundamentals are in the favor of this company at the moment. So some of the descriptions I will just read straight from the internet, because it will be better described by this description, not by me. So to the point. Home Depot is the largest home improvement retailer in the United States, supplying tools, construction products, and services. So that's the first one. Second one is Apple. I think I don't need to talk about too much about this company. The third one is Qualcomm, and the Qualcomm is American multinational corporation headquartered in San Diego, California, and incorporated in Delaware for tax purposes, of course. But what's the core of their business? It creates semiconductors, software, and services related to wireless technology. It owns patents critical to the 5G, 4G, and CDMA 2000, TD, SCDMA, and blah, blah, blah. Mobile communications standards. So, you know what Qualcomm is right now. The fourth one is NVIDIA. So I think I don't need to talk about much about the NVIDIA graphic cards. And there's graphic cards for the professionals and for the retailers, for gamers. And also it creates the system on a chip units for the mobile computing and automotive market. So you know that the NVIDIA has presence in automotive market as well. Okay, so as for the Intel, we know their most of their business is chips. Next one is Moderna. We all know what they create. The most popular product of the Moderna is a vaccine, of course, for COVID-19. The 3M company, and to better, illustrate you, 3M, of course, American multinational conglomerate corporation operating in the fields of industry, worker safety, US healthcare, and consumer goods. So that's the 3M, and the Caterpillar is basically the company with a very long history, and here it is a well described American Fortune 100 corporation that designs, develops, engineers, manufactures, markets, and sells machinery, engines, financial products, and insurance to customers via a worldwide dealer network. It is the most important. It is the world's largest construction equipment manufacturer. So there you have it. You can check from the opening date and time. Again, 1st October, entry points, the current market situation, the current profit. But as I said, you need to have in mind that the most important will be the results after 1 month. So With that said, I'm ending this video. I will be sharing more details about those, the rules that I choose for deciding which stock to take into account into this project. And yeah, so do follow Litefinance on Instagram and TikTok for more content, and see you in the next one. Take care, guys. Bye.